What do you think the bank's going to say? Do you think they're in it for you? They are not. They're in it for themselves. And so what do they say? They say, well, I'm really sorry to hear that, but you don't have an income. There's no way we're going to do a loan for you. And if you don't make your payments, we'll just take your house because there's lots of equity. We're going to be able to sell it at auction and get paid off completely, even if that means you're wrecked. Hey everybody, Derick Van Ness here, investor, wealth strategist, life adventurer, and I got a doozy for you today. We're going to talk about why your 15-year mortgage is absolute suicide, why it's a terrible idea, and I'm going to compare it to a 30-year fixed mortgage so you can understand the differences and why I say what I say. At the end of this, you're going to totally get why I believe a 30-year mortgage is a much better idea, even if you want to pay your house off early, right? So stick with me here. You're going to get this, and I promise it's going to make such a difference for you if you'll just listen and take a sec to think about this. So a lot of people have different ideas, right? A lot of people want to pay off their house. I totally get that, right? It'd be so nice to not have a house payment. And so they go out and they get a 15-year mortgage. And on the surface, that seems like a really good idea because quite often a 15-year mortgage might even have a lower interest rate than a 30-year mortgage, right? Now, why is it? Why would they give you a lower interest rate on a 15-year mortgage versus a 30-year mortgage? Having been in lending and worked with these things, I'll just take a second and explain that to you. It's because 15 years is a shorter period of time, so there's less opportunity, and it's the first 15 years. They can see, based on your finances, what's going to be happening in the next couple of years of your life is pretty easy to predict. The further you get from today, the more opportunities there are for things to change. Your health can change, your relationship can change, your job can change, your situation can change. And so the longer we stretch that out, the more risk there is for the lender. They get their money back slower, there's more things that can happen, and a lot of other variables. So if there's less risk, they'll give you a lower mortgage rate, right? Now, so that can appear like, oh, that's a better deal for me. It's less interest, and I totally get that. But here's the thing, and here's the really big thing that people don't account for, in my opinion, is a 15-year mortgage is significantly more expensive than a 30-year, right? It's not double, but I ran the numbers real quick. At 4% on a $400,000 house, a 30-year mortgage is just over $1,900, $1,909, and a 15-year is more like $2,950. So it's about $1,050 more to have the 15-year versus the 30-year. Now, over time, you'll pay less in total because there's less time for that interest to accumulate. Once again, that can seem like a 15-year makes a lot of sense. Here's why it doesn't. We just went through COVID, and we're still kind of going through that. There was the 2009 meltdown. There was the 2001 bubble bursting, right? We've had a lot of these economic setbacks over the years. And what happens in those times is we need cash. Now the problem is if you're taking that extra $1,050 and instead of saving it or investing it or putting it somewhere where you can get to it, if it goes into the equity of your house, what happens is you may not have a lot of savings, you just have a lot of equity in your house. Now somewhere along that 15 years before you get the house completely paid off, something happens and you don't have cash. If you lose your job or somebody gets hurt or sick, you can end up losing your whole house because when you go to the lender and you say, hey, I know I've been paying this extra money over and above my 30-year fixed mortgage, that extra $1,000 a month, and I've got all this equity in my house. I just lost my job. I don't have a lot of savings. Can I get some of that back? What do you think the bank's going to say? Do you think they're in it for you? They are not. They're in it for themselves. And so what do they say? They say, well, I'm really sorry to hear that, but you don't have an income. There's no way we're going to do a loan for you. And if you don't make your payments, we'll just take your house because there's lots of equity. We're going to be able to sell it at auction and get paid off completely, even if that means you're wrecked, right? And that's a big, big danger in that 15-year mortgage is you're tied into a higher payment, so it's harder to make the payment. And all that extra money is going into equity. It's a place that mentally you might think, oh, I can just go to the bank and get a loan or I can pull that money out. But in most cases, when you need money, the bank will not lend it. It's when you don't need money and you're a safe risk that the bank will lend to you. So what you're doing here is you're kind of creating a double whammy. You're making yourself less appealing to a bank because you have less income and higher debt that you have to pay on that mortgage. And all your money's trapped in a place where you can't get to it if you need it for an emergency. So you don't, in their mind, you don't have any reserves, right? You have reserves in their asset, but not in your own assets. And so that makes you a bigger risk for them to do a loan or a refinance or a home equity line of credit or any of that. Versus a 30-year fixed. And here's the thing about a 30-year fixed mortgage. If you want to pay it off in 15 years, what I would say is make the $1,900 payment, take the extra $1,050 and put it somewhere where it's going to grow for you, right? Now, we use insurance vehicles and some other places to store this cash where you can earn more than the 4% mortgage would cost you. And what happens is instead of paying down a really cheap debt, you're growing your money faster. In other words, it's earning more interest for you than it would have saved for you if you started trying to pay the house off faster. So you can actually get to the same place completely safely without having to take all the risk of the 15-year mortgage and committing to that bigger payment, not having access to the cash. And we'll get into it in just a sec, but the opportunity cost, right, of that asset. If you want to know more about exactly how the numbers work and look on that, like let's say you're like, okay, that sounds interesting. If I take an extra $1,000, like how does that work with something like I break it down with our insurance vehicle? There's another video, and I'll have a link to it up in the corner here at the end of the at this video that I break all those numbers down and you can see exactly what it looks like. But the other big thing that people don't realize is having access to cash when you need it creates opportunity as well as protection. So let's say you're a business owner and you own a dental clinic or an auto shop or whatever. During the downturns, like during the pandemic here or during the 2008, 2009, there's a ton of opportunity. People are retiring early. People are letting go of their businesses or get caught with their pants down and can't pay the bills, so they have to sell their business quickly, which may be an opportunity for you to buy a second or third location, pick up a client base or buy their book of business. Super, super cheap, right? But if you don't have access to cash, you can't do that. So there's an opportunity cost to tying up all your cash in that 15-year mortgage. So I'm a true believer, and listen, I saw this happen in 2008. A ton of people were paying extra, whether it was in a 15-year mortgage or they were just paying extra payments. They were trying to pay off their house faster. What they did was they unknowingly put themselves in danger. When 2008 came along, they lost their job or they couldn't afford the payment. The bank just took their house. And those were the first people that lost their houses because they had all the equity. They were the easy ones that the bank knew, if I take this house back, I'm going to be able to sell it at auction and get my money back. People who hadn't been paying it down as aggressively, didn't have so much equity, the bank negotiated with them. You may have heard of loan modifications and other kinds of forbearances where they take the payments that are behind, they push them to the back of the loan and just let you start fresh. When the bank doesn't have as much equity, they don't have a reason to foreclose on you because they're going to lose money. All of a sudden they're on your team and they want to make sure that you get through this situation so you can continue to make payments, right? So there's a huge advantage to keeping more of your cash in your control. Now, the reason most people don't do that is they're afraid if I leave it in a savings account, I'm not going to earn anything on it, right? There are other ways. Like I said, we really like life insurance, properly structured, right kind of company. You have to do it right. So you want to work with a pro. Our team can help you. Maybe another insurance pro can help you. We do lots of this different kinds of stuff. But whoever you work with, just make sure that they have a plan that's going to get you there. And you can often get there just as fast or faster than if you were paying extra toward the mortgage. So have a 30-year mortgage. If you want to pay it off early, start setting aside that extra money that would have gone toward a 15-year mortgage payment in a place you can get to it where it's going to grow faster than the interest rate you're paying on it, and you'll come out ahead. So I don't know what your arguments are, but if you have questions about this, drop them in the comments below. I would love to hear your feedback on this. I think it's an absolute no-brainer. Get a 30-year fixed, not an adjustable rate. I know mortgages are low right now. If you get an adjustable rate, if inflation comes, you might be in trouble, right? And I did a video on inflation too. You can check that one out. But the reality is, if you can do a 30-year fixed mortgage, take all the extra you want to pay towards it, put it in the right vehicle so it can grow, you're safe along the way, you're going to pay the less just like you would on the 15-year mortgage, and you're going to have the ability to use it along the way if you need it, right? So That's really why I think a 30-year mortgage is absolutely the way to go. If you have your questions or your arguments, I'd love to hear them in the comments below. If you agree with me, give me a thumbs up, like the video, put your comments below. I'd love to hear from you too. Anyway, if you want to see the numbers breakdown on the insurance thing I mentioned, you can go right here, check it out. It's got calculators and the whole thing in there. You're going to totally love it. Anyway, thanks for stopping by. If you've got a 15-year mortgage right now, I would highly urge you to consider getting a great 30-year mortgage just to protect yourself and do this thing the right way. Anyway, my name's Derick Van Ness. Thanks for stopping by, and we'll see you on the next video.